In this video, I'm going to be talking to you guys about the exact trading strategy that has these types of success rate, with 88% on the bullish side, 83% on the bearish side, as well as just under 1,000 pieces of sample size. Now this is back-tested, proven data. And not only that, I'm going to show you guys how simple it's going to be, because all that's required is understanding how to properly trade this setup on the bearish side and this setup on the bullish side. Now, this is the exact method that helped me. Change my trading forever. This is how my journey first started. This was me working on New Year's, finally getting out of work on January 1st of 2018. I've been at this for multiple years. This was a job that I was working, making about $300 to $400 a week, and I was inside the basement of a hookah lounge where I was essentially a slave to my job. However, I was still studying, I was still trying to learn the craft, and I was just making a couple $100 a day. This was back in March 15 of 2019. I was ecstatic, making $246. At the time, I thought I had everything figured out. To now achieving hundreds of thousands of verifiable payouts from multiple different props. And now living the life I want, finally quitting that job way back then, enjoying the fruits of my labor. Now, the best part about the system that I'm about to teach you guys is that it's replicable. Anyone can do it because of the simplicity of it. Here's how Colin had his biggest week after learning how to read daily bias using the engulfing bar play system, which I'm about to teach you guys in this video. Now, the full trading system is also extremely simple, as I've already talked about, which is why anyone can do it. Now in this presentation, I'm going to go over the following, so you guys have an outline of what to expect. First, we're going to talk about what is the EBP method. Next, we're going to talk about EBP method 1, and we're going to talk about EBP method 2, because there's two different types of ways to trade this strategy. Not only am I going to talk about these two different methods, but I'm going to show you guys how to trade the EBP strategy and give you a full game plan that you can implement and utilize. Now, if you guys stay until the end, I'll also go through the data I compiled for indices as well as FX pairs using the EBP method, so you can have full confidence in your trading system. Now, what exactly is the EBP strategy? If you guys are new to the channel, EBP stands for the engulfing bar play. Here we're going to define our terms before we get into the methods. First, we have here a bullish engulfing. Essentially, price sweeps the prior candle bars low, and we close above the prior candle's opening price. That's it. These are the only two requirements that I use to determine a bullish engulfing. Now, here we have a bearish engulfing, where price sweeps the prior candle's bar high, and we close below the prior candle's opening price. Again, these are the only two requirements that I personally need for this to be a bearish engulfing. I do not require it to close below the low. Now, the next concept we will need for this system is the idea of the power of 3, PO3 in short. Now, understanding OHLC and OLHC, candlestick formation. Now, this is going to be very important because we need to understand how the candle forms in order to really grasp the idea of power of 3. So, very simply put, OHLC stands for, we have the opening price, we have the market forming a high, then we have the market forming a low, and then we have the closing price. This is being referenced for a bearish candle. Now, inversely, on a bullish candle, we have open, low, high, close. That is what this is representing. And this is essentially showcasing the bullish candle. Now, how this forms is going to be what we're going to talk about in order to understand that PO3 is a very basic concept. Inside of the formation of a bearish candle, on the open, the market typically will have a push up first, and we actually are going to create a high. Now, once the market goes ahead and creates that high, we're going to have displacement to the downside, form a low, and then the market will close back at whatever price point this is. Now, again, time frame doesn't matter. This concept applies on any time frame, from the 1 minute to the 1 month to the 1 week to the daily to the 1 hour. It doesn't matter, guys. Inversely, we have the open. We have the market dropping lower, creating a low. Then we have displacement to the upside. The market creates a high, and then the market ends up closing at whatever price point. This is going to be essential because what we're going to try to do with the concept of power of three is we're looking to look for sells at this moment when the market has a move above the opening price. Inversely, on a bullish candle, when the market has the opening price, we're essentially looking for buys when the market has lower below the opening price. This right here is power of three, and we're going to showcase how we can actually frame day trades using the EBP strategy with this concept. Now again, guys, this is important because we will use this concept to frame potential trade ideas, and that's when we piece it all together. Now, method number one. There's two methods to trading the EBP. Method number one, I've talked about it before. We're going to use the EBP to frame our trade and get the proper DOL. So DOL stands for draw on liquidity, and this is where the market is going to head to next. Remember the statistics as we talked about in the beginning of the video, the 88% and the 83%, the draw on liquidity, that is the hit rate of how easily the market will go down or up into that specific level. So I used the monthly time frame, the weekly, and the daily. The statistics I showed was based off the daily time frame. And again, stay until the end of the video because I'm going to showcase the data for multiple different pairs. Now, I know what many people are thinking when they see the EBP method one. I'm a day trader. That's too high of a time frame because I talked about the monthly, I talked about the weekly, and I talked about the daily. However, you guys don't have to worry because I'm going to showcase how we can use this to actually frame intraday trades and how your scalps or day trades are actually going to have a lot more momentum. But first, guys, remember this. Patience is essential in trading. Augustine here, he's also noticed this as well. He had this past month in January. It was a month where he sat on his hands a ton. He missed out on a good couple setups. But again, all he needed was a few trades throughout the month in order to get a $3,500 payout from this funded program called Fusion Markets. And again, all he did was trade one of my other systems, which I can make a video about later, Golden Hour, and the EBP. And that's all he says that he really needs. But again, it goes to show a handful of trades and some patience can actually provide a very decent income. Now, method one, trading the EBP. As we had this illustration in the beginning, again, this is just an engulfing bar where the market has an open. We push above the prior candle's high, and we have a closure below the opening price. Now, remember, I'm going to stick to the daily time frame so we can be very consistent. So let's just assume this is a daily time frame. Now, the candle's low in this example on the bearish side is going to be our DOL. It's going to be our objective or target. Now, think of it like this. If we know that this low has an 80% chance of getting hit, we can now frame a potential day trade in order to look for this as a target. Now, how do we do that? We use now the concept of power of three. The next candle, the opening price, we're typically going to look for a move up first before the market hits that DOL. That is very pivotal. Essentially, we're going to take 50% of the range from the swing high down to the swing low, and we're going to map out the range 50%. And what we're looking for is the market to have the opening price and trade up around that 50%. Now, as we go through the examples on TradingView, you're going to see sometimes the market actually does not go up into that area. Sometimes the market just drives up a little bit and we have a move lower into that DOL. We're going to talk about that as well. Now, guys, I really want to clarify. It really is this simple. Most people, they think trading cannot be that simple. They believe that trading has to be this complex thing. However, this is why that's just a false narrative. When you have the data to prove an edge and then you're able to couple concepts together, it can be this simple. And I know it's this simple because people like Queso. Queso is someone who's in my private Discord community, and he's been part of different courses and countless communities. And again, he's been able to get 5 Apex funded accounts towards a payout, and he's been able to pass an account with Alpha Capital as well. And that's what I want to show you guys, that irregardless of what other people say out there in terms of different strategies and all these complex systems, you can be profitable using a very simple approach. And that is what Queso did here. But now let's go ahead, let's get into TradingView to look over a few examples using the EBP method 1 and how to enter trades. And then right after this, I'll go into the EBP method 2 and how we can use that system for even more lower time frame trades. So here we have a chart of gold. Now we're going to go ahead and we're going to outline the setup. Number one, what do we see is the EBP. So we see how the market takes out the prior candle's bar high. And then we have a close below the opening price. Again, typical retail or some people will use the low of the candle. For me, I just require the opening price. We sweep the prior candles high, and that's it. What we also see is that the market also took out this prior liquidity pool. So when we see the market taking out multiple liquidity pools as well, this adds as an additional confluence. Now, the way I personally like to trade as well is identifying where could the market head next. But for the sake of method one, we're going to keep it very, very simple. We understand that when the EBB forms, we're going to have the draw on liquidity, which is going to be this candle low. Now, what we're typically looking for is the market to have that next opening price, have a rally and then a drop lower. Now, the key thing is this is a daily time frame. What I'm typically going to look for is on the 4-hour and the 1-hour time frame, is there some sort of PD array or reference points we can use for an entry time frame? So let's go ahead and let's break down the 4-hour time frame. So now we have the 4-hour time frame, and I'm going to go ahead and actually put the indicator on. So once the daily bullish prints, we're going to go into the next day. We can actually see the liquidity that's resting on the DOL, as well as any imbalances that are present. So when we play this forward, the market goes into the next day. So this right here, all this is the daily engulfing bar candles high and the low. So if I go back to the daily time frame, we're going to see how the market forms this right here. Now we're going to go and just go back to the 4-hour. Now, as the market is going up into this fair value gap, we're going to go down to a time frame lower, and we're going to try to look like, hey, can we find a potential entry? Now, this is where we use lower time frame entries. I have multiple different lower time frame entry models, and I'll make a separate video for that. But we can just look for a very basic thing like a market structure break. So we have this overall fair value gap, and this is what I mean. If you have a bullish market condition, all we want to see is that the market has, let's just say there's a fair value gap, maybe there's, an order block, a breaker, something that essentially has a shift in market structure, where the market structure has a shift. Then we also have the opposing side, and then we just look for something what I call the backside move. So we're looking for the market to go shift from bullish market structure down to a bearish one. So we're looking for bearish fair value gaps. We're looking for bullish PD arrays to be broken. We're looking for a shift in order flow. So let's go ahead and we're going to play this forward. And again, if you guys want a separate video on lower time frame entry models, comment the word lower time frame entry and I'll go ahead and make a separate video for that. So we go ahead and we see, and this is what I wanted to see. Look how we have this overall fair value gap that's present in here. Next, we have the market trying to make a push higher at this very point. So we have a failure swing. The market fails to make a new high, and we're going to see how this overall reacts. And we see the next candle open, the next candle pushes higher, and then we actually drop lower into our DOL. Now, if you want to get even more granular, you can look for different setups in here on the M5, M15, as long as it's within this time window. Now, as we play this forward, we're going to see the market actually has a bigger drop lower and off to the races. So when we go to the daily time frame, this is how it looks, and the market actually has a much bigger drop than expected. So push, look how, again, the concept of power of three. We have the opening price, we have the market rally up, and this simply is just the range divider. So I'm going to go ahead and show you guys my fifth settings as well, where this, and again, just have this coded. So it's 25% is this range in here, and this is 50% mark. So again, we're looking for the market to rally up into one of these areas. If it goes up to 75, it's not as ideal, but again, that's what we're looking for. And we also have this fair value gap that's present. So this could be a bigger term objective, and all we're looking for, again, is just a simple day trade where we can find the potential short in here, look to maybe take profit down here. But again, the first DOL that's proven statistically is that this has a high chance of being taken out. Now, let's go ahead and let's look at another example. So here we have an example on NQ. So we have the engulfing bar because it sweeps the prior candle bars low. And we also have confluence because it takes out multiple liquidity pools to the left of us, as we can see here. And we have a closure above the prior candle's opening price. Now, again, the opening price. To me, it does not need to close above the prior bar's high. Now, we have the next candle that opens, and we're going to see how this trades to the higher time frame. So again, guys, remember, using methodology 1, we're just looking for this as our potential DOL, and then you can target something a little bit higher, like let's just say you were targeting maybe the closure of this fair value gap. That could be another objective. But remember, for methodology 1, we're typically aiming for that DOL, and we're looking for a lower time frame entry. So let's go ahead and let's look at a lower time frame to see if we can see any entry confirmations. So now here what we have the 1 hour time frame. So within the 1 hour time frame, we can see that within this area we have this imbalance that's already plotted out. So we're going to extend this piece out. Not only that, we also have liquidity that's been resting below this low, and we see how the market drops lower, pins that, and we have a market structure baked to the upside. So as we go ahead, I want to show you guys how this looks in real time. the market goes, sweeps liquidity into a higher time frame level. We still have this as our potential objective. And then what do we have here? We have the market have an impulse push up, and we also have essentially this order block that forms in price. We have a closure above this prior consolidation, a market structure shift. We're going to see how this plays out in the next candle. Nice retest that the market has in here. And we're going to see how this plays out. Consolidates until we start to get that expansion move higher into the following day. So let's go ahead, keep playing this forward. Price hits the objective, and then we are off to the races, further expansion. Now again, how do you play this? So there's two different types of ways I like to trade it. Now, I don't want to make this video too long, but trying to buy the dip, the problem with this is your stop loss would have to be pretty wide, right? So if you're buying, let's just say on this fair value gap within the overall range, your stop would essentially go a little bit below here. Now, we don't know for sure if the market is going to have a reaction. That's why it's a little bit more quote unquote safe to wait for some sort of market structure shift to the opposing side, as long as we have our DOL that's still ready. And then we look for the market to kind of have that some sort of retest. Once we break back above, we have a market structure shift, and order flow is now shifting to the buy side. So here's a perfect example of NQ. And typically how you could use a stop loss is by essentially just placing a buy order here. You place a stop loss. I like to usually use the bodies of the candles in here. And then you look to target that specific high. That's about 1.12. But again, this one further. And you can kind of trail your stop loss accordingly to try to maximize the opportunity on these trades. Now, remember, we can go even further on the lower time frame, but I'm going to leave that for a separate video. I just need people to understand how to use the lower time frames, like the 1 hour, the 4 hour, to enter with a very specific key window in order to maximize on the higher time frame bias. Now, let's go ahead, let's get back into the presentation, and let's talk about the EBP method 2. Now, I'm about to show you how I personally use the EBP method 2 for day trading, and how I use that to help me make just over $13,000 in just a few trading days. This was back in last month. Now, the EBP method 2 is very simple. For this, we're going to be using the 4 hour time frame, and we could use time frames lower, but I personally prefer the 4 hour. Now, how are we going to use this? We're essentially going to use the 4 hour bar in order to help us determine the potential bias, and not just the bias, but the potential trend. Now, we're going to get into it on TradingView, so just give me a second while I show you guys a few examples. But before we head to TradingView, I want to illustrate this point. Usually, the engulfing bar on the 4 hour time frame can typically signal some sort of trend reversal or trend continuation. Two types of market profiles that we can use to determine a trade. So, as here we have the market sweeping the prior candle bars high, and we have a closure below the prior candle's opening price. As we play this further, we see how this actually set the stage for a market reversal, and then we ultimately headed lower. Notice how we even have a secondary engulfing bar that forms, and again, this continues the market trend to the downside. This over here marks the potential reversal and how the market ultimately topped out at this price point. Now again, what do we have here? We have the market forming a bullish engulfing because we took out the prior candle bars low, we closed above the opening price, and we even engulfed above this overall range in here. So this was even showing a market structure shift and a potential shift in order flow after liquidity was taken. Now, how can we use this? Look at how the market has this swing low to swing high. We come back into a discounted marketplace, and now this is showing us a potential for a continuation. Notice how the market comes back, tests the order block that was formed, and then we have a consolidation before the expansion higher, and we ultimately make this higher high in here. So again, guys, remember, the market is going to do one of two things. We're either going to have some sort of reversal profile or continuation. And when we can identify these engulfing bars on the 4 hour time frame to frame either a reversal or a potential continuation, this will help us determine the overall trend and what direction we should be looking for near term for day trades. Now, let's go ahead. Let's take a look at more examples. Here, notice again, the market ran up. We took out the prior bars high, and we had a closure below the opening price. As we play this forward, again, we get to see that the market, the next candle is an inside bar, meaning this candle is inside the prior range. We created a fair value gap, and the market sends the market lower after trading at this fair value gap, and we send it lower. We also have another bearish engulfing here, and this sets the stage. Now, again, this gives us the potential for a confirmation to look for that direction in trend. Remember, before on the daily, On the EBP method 1, we were just looking for that DOL, but this can actually ultimately give us the direction for the day or the direction for the next few days. Again, similarly in here, notice how we take out this prior bar's high, we take out the liquidity, and then we drop lower. Then notice the next candle notice here we have the next candle where we push up, drop lower, and again, this signals a trend continuation. Remember, one thing about the market needs liquidity in order to set the stage for the next market move. That's why the engulfing bar is very powerful in the 4-hour time frame. Now, if we can actually put this together with context, like using structure, using higher time frame levels, using daily and weekly profiles, we can really create a system around that, which puts us in a position to make an obscene amount of money. But let's go ahead and I'm going to show you guys a breakdown on a few examples on TradingView. Now, here we have an example on NQ, and we're going to go over what we just talked about in terms of the market having two types of market conditions, right? We're going to have the market forming some sort of continuation, or the market is going to form some sort of medium-term reversal point. So let's go ahead and I'm going to show you guys the first one where we look for trend continuation. Notice how the market has an impulse low to high. We have this fair value gap. The market trades down into it. We take out the liquidity and we touch this fair value gap and we have the engulfing bar. Now, this is how we personally trade it. If the next candle, I'm typically looking for the market to have a retracement back into the 25% or to the 50%. Many people will ask, how do you know, like, should you take it here? Should you take it there? It's going to be based off personal preference. Now, you could go on the lower time frame and actually look to maximize on this move. But again, for the sake of the video, I'm going to give you guys one methodology. Then typically you want to put your stop loss beneath the candle bars low, and you typically want to target something above market. So maybe we have this little bit of an inefficiency. We could target this high, or you can do a static 1-to-1, or you can do a static, 1-to-3, 2-to-1, whatever the case may be. So up in this move essentially gave us just under a 2R move. If you put the stop loss right at the low, you would have been able to get a 2R on this trade right here. And again, guys, it's using basic structure. So notice we have the market form a swing low to a swing high. We have a fair value gap that forms in here, and then we have the bar that forms. And the ideal situation, we still have not met the higher high. So for the market to continue higher, we're typically going to be using this as our potential target. This gives us a really good opportunity to look for the market expansion higher, and it gives us a good opportunity as well to target something that has not been met yet. So let's go ahead. I'm going to show you guys one more example of a continuation. So here we have an example on gold. Now, what do I see? First, there's an impulse leg from swing low to swing high. We also have this fair value gap, and we could just draw from the overall swing point before the market made a move higher. And when we draw our reference point, what do we see? We see the market comes back into this fair value gap. Now look at how we have a confirmation, and now the market closes as a bullish engulfing. This is what I mean, guys. We typically know if the market is going to have some sort of continuation higher, close to this high, we're going to need some sort of confirmation on the backside. Sometimes we can use like a market structure shift, or we can just use a basic engulfing bar as a confirmation entry. Notice how the next candle opens up. We go down to that 25%. So again, based off of what we were talking about. Now, on a very long wick like this, you could lower your stop loss and put it around the 75, like just under the 75%. So this right here, this overall range is, if you draw the fib from swing low to swing high, this is 25, 50%, and 75% of the range. And if you guys want to see the settings real quick, and here are the fib settings for this, and I pretty much put this as my range divider. Now again, the indicator is coded, so it just populates automatically. You could put your stop loss beneath the 75, and you could just look to target some sort of like high, or like, let's just say on the way up, we have this whole area in here where we have these wicks, and we have a rejection block. As we let the market play out, we see how the market hits the overall objective in here, and that would have met our 1 point, like this would have been 1.73. Let's see if we get a 2R reverse, and beautiful. Right there, the market gives us the 2R. And right there, this could be your trade model. Just look for continuations and then reversals. Now, let's go ahead and we're going to take a look at the reversal side of things and how we could play that market profile. So here we have NQ. Now, this is a perfect example of a reversal profile. Notice how the market has been trending higher, and we even left a gap in price. So notice we have this gap from the market open. and the market does come down lower. We do try to trade up higher, but then notice how we have a failure swing. The market fails to push higher and we have an engulfing bar that forms. Now again, notice how the next candle opens, we trade a little bit higher, we have a little bit of a deeper retracement, which is fine in this case because remember, assuming, let's just say the market does have a closure near the 50%, you could just enter right on that candle. You do not need to wait for a lower time frame entry. You could just enter, especially when the bar is not that big of a candle. So let's go ahead and let's see how this one would have played out. Now, obviously there was some sort of news event in here. So let's just say you entered on the bar close. Again, stop loss is typically right above the candle bar's high. And let's just assume you were looking for maybe this as a near-term objective, or maybe you were looking for this fair value gap. Even though obviously there was a big move, you would have got the 2 to 1. This would have been just about 2.55R. Now, when we play this obviously all the way down here, that's a huge move. That's about a 9R trade. Now, the truth of the matter is this. Are we always going to catch moves like this? No. But I will say this. The benefit of trying to catch sometimes reversals is if this is a reversal on a 4-hour time frame. However, imagine this was actually a potential lower high point on a daily time frame. You can actually anticipate massive moves because we're typically going to see a reversal on the time frame that's lower. However, let's go ahead. Let's look at another few examples using the reversal. So here we have another example on NQ. And the thing I like about this one is it sweeps multiple liquidity pools, right? So we have this little bit of a consolidation. The market rallies up. We sweep liquidity. And the one thing that I do like is that we have a very clear downside objective. We have this fair value gap that has not been traded to. So notice how the next candle we trade up. This could be our potential entry. So let's go ahead and we're going to put a short position on around the 25%. We're going to put again our stop loss right above the candle bar's high. And we're going to aim for a modest, let's see if we get down to that 2 to 1 risk to reward. I'm not a big fan of static risk to reward. I just like to see how the market is ultimately going to play out. So we have this near-term objective, 2R gets smashed. And again, the reality is you could monitor the position once we kind of get inside this fair value gap in the event that this actually sends the market higher. But in this example, 2R objective got hit. It went all the way down up to 2.71 RR. Now, this is the big benefit of being able to identify potential reversals is when the reversal actually does top out, we typically have very big moves as